CrowdStrike reports earnings on Thursday. Shares are down roughly 18% year to date. Should you sell your shares before earnings? Let's find out. Here's a look at the portfolio I'm sharing here publicly on YouTube. The goal is to build it up to $1 million and share everything transparently along the way. We do full portfolio reviews on Fridays where I walk through every company and my thesis and the valuation for those companies. Right now, we're talking about CrowdStrike. As you can see, CrowdStrike is the third largest position in my portfolio. It's about $7,600. Let's take a look at what management said for CrowdStrike's last earnings report. They reported this on March 9th, 2022, and it was for fourth quarter and fiscal year 2022. They achieved record net new annual recurring revenue of $217 million, with growth accelerating for the second consecutive quarter. We love to see that. Ending ARR, annual recurring revenue, grew 65% year over year to exceed $1.7 billion. They delivered record operating and free cash flow for the second consecutive quarter, bringing operating and free cash flow for the fiscal year to a record $575 million and $442 million, respectively. We love to see that. We love to see accelerating revenue growth and improving operating and free cash flow. For the fourth quarter of 2022, they grew total revenue at 63%. They grew subscription revenue, which is a little bit more reliable. That's people that are subscribed to month or even longer contracts, at 66% year over year. Gross margin is very strong. Subscription GAAP gross margin was 76%. GAAP loss from operations was $23.5 million. GAAP net loss was $42 million. I'm okay with that. I think this company is investing for growth. GAAP takes things into consideration like stock-based compensation. Non-GAAP or adjusted takes that out, and they are profitable on an adjusted basis when you remove things like stock-based compensation. A lot of people don't want to own companies that use stock-based compensation and that are unprofitable on a GAAP basis. I'm okay with it as long as I see improving metrics and a path to extended revenue growth that they can then turn into GAAP profitability in the future. I believe I see that with CrowdStrike, so I'm happy to own shares. And what's important right now is revenue growth, improving metrics for that GAAP earnings profitability, but I'm okay with them being unprofitable, and then improving cash flow because that's the cash that their business generates. That's how the business essentially stays alive. Net cash generated from operations was $159.7 million compared to $114 million. So improving net cash from operations. Free cash flow was $127 million compared to $97 million. So both improving free cash flow and net cash from operations. And then cash and cash equivalents, $2 billion in the bank. That's what we like to see. That's a strong balance sheet, and that's how a business is going to stay in business long enough to grow and become profitable. If their cash position was dwindling and they were going to have to raise, or they were potentially going to go bankrupt, that'd be a much different story. But I'm okay with CrowdStrike's model, and I think they're investing for growth, and that's what I like. They also provide guidance. So during last quarter, they provided Q1 fiscal year 23 guidance, which they're reporting on Thursday, and then full year fiscal year 23 guidance. The two numbers that analysts and I'll be paying attention to, although I don't really care from a quarter to quarter basis as long as long-term the thesis stays intact. Sometimes if they have a small adjustment one way or the other, they don't beat by enough and the stock sells off, those could be good at buying opportunities. I'm going to, again, review their earnings when they come out, so just make sure you're watching the channel for that. But this is what management provided. They think about $458 million to $465 million in revenue, somewhere in between that. And then for the full year, $2.13 billion to $2.16 billion in revenue. And then non-GAAP net income per share between 22 cents and 24 cents for the quarter, and then between $1.03 and $1.13 for the full year. So let's kind of zoom out and look at what analysts are expecting. This is ticker.com. They get this information from S&P Global Capital IQ. They just pool together analysts' expectations and give you essentially an average of what analysts are expecting. This is what they reported in their last quarter: 63% year-over-year revenue growth, And if they come in at 464 million, which again that's the number analysts are going to be focused on in revenue, that's about 53% year over year. And then when they guide for Q2, analysts are currently looking for 509 million, or about 51% year over year revenue growth. So analysts are really going to pay attention to this current earnings and then guidance for next quarter. They'll also really focus on adjusted or non-GAAP earnings per share. In their last quarter, it was 30 cents. This quarter, analysts are expecting 23 cents and then guidance for 24 cents. So again, they're really going to focus in on that. This is Seeking Alpha. I like to use Seeking Alpha because it's a great place that aggregates kind of a company's previous performance. And right here, you can see since the company went public in their first quarter reported Q1 2020, they have beat earnings every single quarter, and they have also beat revenue expectations every single quarter. Most recently, they beat by about 18.6 million and 10 cents for adjusted EPS. So we will look for that trend to continue, and that's a trend I love to see in companies I own. Revenue estimates in terms of analyst expectations for the full year, fiscal year 2023, 2.15 billion. That puts it at a forward price to sales ratio of 18. And then for January 2024, 2.92 billion. That puts it at a forward price sales ratio of around 13. So very high for what some people like to own, but I'm comfortable owning it. Love to look at Morningstar and what they're thinking. Morningstar currently has it rated as a 4-star stock, which means they think it is at a discount to their estimated fair value. They have fair value at 225 for CrowdStrike. It last closed at 166. I think it's around 164 right now, down about 1%. People are just worried about earnings, and so it's trading up and down according to that right now in the broader market, obviously. 1-star price where they think it's overvalued would be 348, not anywhere near there. 5-star where they think it's just, the most undervalued that they even rate would be 135. They think they have a narrow economic moat. I actually disagree with that. I think CrowdStrike's model is a little bit stickier than what Morningstar is giving them credit for. They have broadened the modules or the different types of security subscriptions that they offer to their customers, and their customers are adding more and more of those modules on average. As they do that, CrowdStrike spreads across more of the organization and they have more things covered. And once you do that with a security vendor, I think you're a lot less likely to just want to go and change vendors, especially if it's working. Additionally, they have a threat graph, which is almost a network effect for all of their customers. So the more customers that they sign, the more data that they get, the more threats that they defend, and they can then use those learnings in that data to apply to all of their customers. Capital allocation, they have rated as exemplary. That's because of that $2 billion in net cash. And then, not to give too much of their service away for free, but basically Morningstar came out and upgraded a bunch of security providers, and they held CrowdStrike, Okta, and Zscaler. They reiterated their price targets for them. They didn't raise them, whereas they raised them for other companies like Checkpoint and Palo Alto because they've posted some great results. Finally, let's jump to fast graphs. I use fast graphs just to get ranges for what could happen based off current analyst expectations and potential price to sales multiples in the future. None of this is guaranteed, but I just like to look at ranges. It's currently at a blended price sales multiple of about 23. That takes in the weighted average of the most recent results and their actual value with the closest forecast value. So that's a blend of their most recent results, so their trailing 12-month price to sales ratio and their forward price to sales ratio based off current expectations. That's what Fast Graphs uses. Every service out there is going to be a little bit different, but I kind of like this because it's a blend of what's happened plus what analysts are expecting in the future. So down here, I have built in revenue growth per share that analysts are expecting. Again, pulled from this data from Ticker, from S&P Global Capital IQ, and put that out through fiscal year 2028. So we've got 46% revenue growth per share for fiscal year 23, 35%, then 25%, 30%, 37%, down to 32%. So if you notice, that's decelerating revenue growth. So I'm not just painting this perfect rosy picture of them growing 40% forever. So trying to take that into consideration. And then we have them at a current blended price sales ratio of 23. And what I'm building in this target is out to a price sales ratio of 10. So that's shrinking down, contracting almost by 50% from 22 to a price sales ratio of 10. Even with that, you would still get 122% total return for 15% annualized. As a reminder, the S&P 500 generally returns 8 to 10% per year. So if I can get this type of return from what I think is a high quality software company that's in an important industry, a leader in that industry, and is going to grow revenue for a lot longer, I think, than just through fiscal year 28. We'll monitor along the way and see. I love that return potential. But let's also look at a range. Let's go down by 30% to a price to sales ratio of 7. Then we're only looking at 55% total return and an 8% annualized return. So not great, but at least positive and about what the S&P 500 does. Again, if the price sales ratio shrinks to 7 from 23. And then let's go up by 30% to a price to sales ratio of 13 and up by 30% from that 10 baseline. We're looking at a total return of 188 and an annualized return of 20. I'm happy with those numbers for a company in the phase of growth that CrowdStrike is, that is showing the ability to grow and become more profitable over time. I don't even think it's really worth considering price to earnings multiples right now because they're investing for growth and they're showing progress towards profitability. I don't just own companies that are investing for growth at all costs and getting less and less and less profitable and not even showing a potential path to profitability. Companies that come to mind are like Uber, Lemonade, companies like that. Not interested. So the question becomes, Austin, what are you doing before earnings? Am I selling my stock? Am I buying puts? Am I hedging? I'm not doing any of that stuff. I own the shares I own. I want to own them for years. I have new money coming into this portfolio and I share how I invest that here on YouTube. If you want access to that stuff and write-ups on the stocks that I'm buying before I buy them, the best place to get that is my newsletter, austin.substack.com. There's a link down in the description. But other than that, I'm going to share everything transparently in weekly update videos on Fridays right here on the channel. I'll get that earnings review out after CrowdStrike reports on Thursday, and we'll do a full portfolio review on Friday. So do me a favor, you can support me by liking this video, subscribing to the channel, take care of your mind, your body, and your money, and be good to people out there.